Hey everybody, I hope you're doing well today. Well, this is the introduction and overview video for balance of payments, maybe students' most difficult section of the international economics curriculum in the IB syllabus. Here's the thing, you gotta go slowly, you gotta let the information go through your head once, then you gotta circle back and let the information go through your head again, and then you gotta go back a third time to make it all happen, because so much of this is new material, it's new discourse, it's new ideas. I'm going to try my best to make it as simple as possible, but it's still going to take some effort, okay? So balance of payments, what does that say? That says that in the end, every country at the end of the year will have an equal amount of money flowing out of the country that's coming into the country. In other words, it will balance. The payments between any country in the rest of the world will balance out every year. Okay, so hang on to that idea and we'll slowly build the knowledge base in our heads. So let's get some key terms in our head before we move through the specific aspects of balance of payments. First of all, I want you to think about the balance of payments as like a big old checkbook of a nation, right? This is like what accountants do. This is the accounting of how much money and goods and services are flowing out of the country versus how much are flowing back into it. Okay, so if you think about an old school checkbook, maybe you saw your parents, maybe you have your own checkbook, but just keeping track of how much money you spend versus how much money you earn, right? And in the end, it should always balance out. Okay, so a definition, official economics definition of balance of payments. The balance of payments account is a record of the value of all the transactions the residents of one country and the residents of all other countries in the world make over time. So the period of time is always a year. So it is the record of the value of all transactions the residents of one country, I live in Chile makes, and the residents of all other countries make, in reference to Chile, in one period of time. Okay, cool. There's the definition. Now, there are two main parts to the balance of payments account. There's something called the current account, and something called the financial or capital account. Current account and financial account. Current account and financial account. Okay, so the key point here, just layering this in, don't worry about having total understanding yet. But a key point to remember is the current account plus the financial account will always equal zero. It'll be balanced. That's why it's called balance of payments. Okay, so the current account plus the financial account will equal zero. Then you know that probably it has to be that one of these is going to be a positive number and one of these is going to be a negative number. Otherwise, they can't equal zero. Otherwise, it wouldn't be balanced. Okay? So if the current account is running what they call a deficit, then the financial account would be running a surplus. If the current account is running a surplus, then obviously the financial account must be running a deficit. So it'll always equal zero. Don't worry why that's true. Just accept that for now. Okay? And as you go through these lessons, you will come to understand how that works. Okay, some key items here, key terms. First of all, credit item. A credit item is any transaction that leads to the entering the country of money, leads to money entering the country from abroad, is known as a credit item in the balance of payments and is given a positive value. Beautiful. So any transaction where money is flowing into the country. So for example, if Chile is exporting a good, what's coming back? The money. Okay? So any exports would lead to money entering the country from abroad, and that's going to be a credit item. A debit item is any transaction that leads to money leaving the country to go abroad, is known as a debit item in the balance of payments, and is given a negative value. So obviously, right, if Chilenos are buying things from the United States, the money is leaving the country, it's a leakage, and the good might be coming back, but the money is leaving. So we're always tracking on the money. And if you think back to the circular flow of income, this is in the upper portion of that drawing, right? It was up here, where you have leakages and injections into the circular flow model. And we're going to deal with the balance of payments, which is really functioning right up there in that one section of the circular flow model. Okay. So hold those things in your mind. That's a nice introduction to the whole concept of balance of payments. If you want to think about the circular flow model, it'd be a nice thing to add to this, right? We're talking about the foreign sector and the way in which a country interacts with the foreign sector being the entire world. Okay? I hope you found this video to be helpful, and we'll talk to you in a bit.